Lori Calvasina, head of U.S. equity strategy for RBC Capital Markets. And you've been telling your clients, Lori, of some levels and some things to look out for to sense a bottom. What are they and how close are we?
Sure. So look, let's just put the performance in context. With the 20% drawdown, if we get to, say, the 38.50 mark, we're basically going to be right back where we were at the end of 2018 when we saw that big drop around the China trade war and QT from the Fed. We've seen other similar growth scares in the past, which have ranged from 14 to 20%. So I think if the market, kind of moves past this 20% threshold, it's essentially going to be pricing in a recession. I think, though, you can see the market kind of resisting that urge, kind of bottoming out in intraday pricing both this Thursday and last Thursday, right above that 38.50 mark. Look, if you look at high net worth retail, the AAII poll is telling you that sentiment has been pretty washed out for quite some time. If you look more on the institutional side, the CFTC data is telling you things like small caps and the Dow are washed out with positioning at or below financial crisis lows on a notional dollar value basis. It's got a little bit more room to travel on the S&P side, but I do think this market is trying to bottom and really would like to, but is still wrestling with the fundamentals.
Well, and the fundamentals moving to earnings this week, really, that was where a lot of the wake-up calls came from. Eric Johnston was on with us from Cantor, and he was saying that really the earnings expectations haven't been marked down that much, and that's going to start to happen, especially when you see margins get hit at a Walmart and a Target. Is that your expectation?
Look, I do think there is some vulnerability in certain sectors, but if you look at the rate of upward revisions in the S&P 500, there have been certain sectors, things like REITs, things like financials, energy, more of the value inflationary side of the equation. Utilities is another, where you've seen actually more upward than downward revisions, and so that's giving some support to overall earnings expectations. Many other sectors, though, things like consumer, industrials, materials that are more sensitive to the problems we're all wrestling with today on inflation, you actually have seen some downward revisions there. So, yes, I do think certain sectors are at risk, but I do think it's important to take note of the fact that this is a pretty broad market. The S&P is pretty diversified, and some of the things that are actually benefiting from this inflationary environment have been, kind of buoying the numbers overall.
Consumer discretionary versus consumer staples. They both tanked yesterday on the Target news. They're moving in opposite directions today and really have been for most of the year with staples as the safe trade. Which do you like better, if any?
So look, we're neutral, both of those. But I would tell you that in terms of overall valuations, consumer discretionary has been starting to look quite cheap on a relative PE against the broader market, while consumer staples has actually been up around peak levels on a relative PE against the broader market. So I think the price action is really interesting today after yesterday's big drawdown in both of those sectors. What I'm seeing today is that the market is trying to go after the one that looks cheaper, that has a valuation case, and is avoiding the one that's been quite overvalued and done really well. I think that's actually a healthy trend underneath the surface.
So you're neutral, though, still on it. What sector do you like the most if you do think this is a market that wants to bounce?
So we see puts and takes. I would say if there's more risk in one, I actually think it's consumer staples from a valuation perspective. We've said, if you look across all the different defensive sectors, that is probably the one we like the least if you're sort of comparing things like healthcare, utilities, and staples. And the earnings expectations have been starting to get worked down, but I don't think they've bottomed yet if you look at the rate of upward revision. So I'd say there's probably more risk that needs to get priced in on that side.